Have a good day. Today we will be going into the sixth module of security analysis and portfolio management paper. The topic for the sixth module is fundamental analysis. So, in the first lecture of fundamental analysis, I would be discussing about the overview of fundamental analysis, which includes introduction to fundamental analysis, the approaches of fundamental analysis, the components of fundamental analysis, importance, and the difference between fundamental and technical analysis and the key differences. So, first let us go into the introduction of fundamental analysis. So, fundamental analysis basically talks about studying the financial information of companies to take care of the economic trends which is happening in the arena in the country in which we intend to take up the study, and then the industry conditions so that we can estimate the intrinsic value of the asset. Here the intrinsic value of asset is an important aspect which you should understand. So, intrinsic value here talks about the value of the asset, value of the company's share based on the asset holding of the company. So, there are two types of value which we can discuss over here. One is the book value and the other one is the intrinsic value. What is the difference between book value and intrinsic value is? Book value is nothing but the difference between the historical cost and depreciation is recorded in the books of accounts of the company. So, every year you will find that if asset is purchased at 1 lakh rupees and you have a straight line depreciation of 10%, it means to say that 1000 rupees gets deducted every year, and the value of this asset becomes 99,000 in the second year, and then it goes on for 10 years. So, let us assume the book value is 99,000, but when we are talking about the intrinsic value of the asset, it talks about the value of the share based on the actual assets the company is holding, and the actual asset holding of the company takes into consideration the market value of assets. So, this is the difference which happens over here. So, in book value we are deducting the depreciation from the historical cost at which we purchased it, whereas in intrinsic value we are considering the market value of the asset which the company holds, and based on this value we are trying to calculate the value of the share in which we intend to invest. So, that is one important aspect which we should understand in fundamental analysis. And why we do a fundamental analysis is to identify whether the stock is either overvalued or undervalued. What do you mean by overvalued or undervalued? Let us assume that the company is having an asset based on the market value or the intrinsic value. You have the value of the asset coming out to be 1 lakh rupees, okay, and you have 1000 shares or 10,000 shares which is floating in the market. So, this is the number of shares outstanding. So, the value per share comes out to be 10 rupees. Now, let us assume the market value of the share is 9 rupees 80 paise. So, which means the market value is not a true representation of the actual value of the stock which you intend to purchase, which means this is undervalued. And if suppose this comes to 10 rupees 50 paise, it means to say that the actual value of asset is 10 rupees, which is being traded in the market at 10 rupees 50 paise. So, which means it is overvalued. So, which is the best condition in which an investor would like to put in money into a particular share is when it is undervalued. So, you can purchase a share at 9 rupees 80 paise which has an actual value of asset of 10 rupees. So, in near future or in case of liquidation of the company, you are likely to get back 10 rupees and you will be saving 20 paise on each of the shares. So, it is always better to purchase a share undervalued if it is possible, and then keep it for yourself and then sell it when the price increases. So, overvalued you have to be very careful while purchasing it, because that may not be the true representation of the asset of the company. When we are talking about the different approaches to fundamental analysis, there is top-down approach and a bottom-up approach. So, what is top-down approach? So, whenever we talk about fundamental analysis, the sequence of analysis which we undertake is economic analysis, then we do industry analysis, and then we do the company analysis. So, this is the normal sequence which we follow. So, this is the top to bottom approach. So, if suppose we do the analysis in the opposite direction, that is, first we undertake a company analysis and then we talk about the industry and then we talk about the economic analysis, then it becomes a bottom up approach. This is top down. Okay. Now, what are the key components of fundamental analysis? As I told you in the previous slide, there are three basic components which we consider analysis. First is the economic analysis. So, economic analysis, as the name suggests, it is a broad perspective which we are talking about, where we are saying how a particular economy is behaving and how what are the various other factors which has an influence on the economic factors. So, the individual factors which can have an influence on the economic environment are the GDP, the inflation, interest rate, employment rate. Some of them are mentioned over here. As we go into the details of it, you will understand many more things to come, like foreign exchange, etc., etc. So, I have just mentioned a few of the things which we will be considering in economic analysis. Next, once you do a broad study about the economy, where you are saying that the economy is either favorable or not favorable for an investment condition, then we go into the next type of analysis, which is called the industry analysis. Let us assume the economy is favoring investment. Then we do an analysis of the industry to find out which is the best industry in which the money could be invested. So, here how do we find out? Let us assume that the infrastructure industry is in boom. So, it means to say that it is better to put your money in infrastructure, or pharmaceutical might be in boom, you can put your money in pharmaceutical. So, it's not that only one sector would be always better than the other. There could be multiple sectors behaving in a similar pattern. So, I can put in my money both in pharmaceutical as well as in infrastructure if both are doing well. So, that is the next stage which we have to do, where we are doing an industry analysis, and while doing the industry analysis, we are trying to understand the competition factor, the regulations which is there, and the life cycle of the industry in which we intend to put our or invest our money. So, that is part of industry analysis. And the third part comes that once we have seen the environment to be conducive, second, which is the best industry we can put our money, then the third part comes as to identifying the best firm in which, within that particular industry in which we can put our money. For that, we have to do a company analysis, and company analysis talks about the financial health of the company. And financial health, it can be measured in various ways. We will go to those aspects when we go into the company analysis in detail. And then it also talks about the operational efficiency of the company and whether this particular company has a potential for future growth or not. So, based on these three parameters, we are trying to identify whether the company which we have identified will give us the return which we expect or not. Why an fundamental analysis has to be done, or what is the significance or importance of fundamental analysis is, first one is investment decision making. So, when we talk about investment decision making, investment is nothing but the savings which we have kept apart and which does not have a role to play in near future. So, you can park that money for a particular period of time. So, that is what you mean by investment. So, if suppose I have some money which I do not require right now, and I know that the use of it would come after 1 year, 2 year, 5 years, then I can park this money in different sources. It could be in my bank account, it could be in insurance policies, it could be in mutual funds, or it could be in the individual shares of the company. So, when I am talking about investing in individual companies, then the investment decision making will help me or will make me to do a understanding of the company's true financial position, and based on the company's financial health, I would be deciding whether this particular company is good for me to invest or not, and whether I would be getting the expected return or not. So, this is possible only when I would be getting an excess return than the risk-free rate of return. So, risk-free rate of return might have been discussed with by Dr. Anandita Chakravarti when she was taking about capital asset pricing model. So, here one thing you should understand, I am not going into detail of it, just a brief of what it is. So, when do I put in my money in companies or in any other stocks which is available with me, is when I get something over and above the risk-free rate of return. What is this something which over and above? That is the premium. Premium by taking the excess risk by putting my money in shares. How do I calculate the premium? Premium is nothing but the return on the share in which I have invested minus the risk-free rate of return. So, this is what I am trying to do. So, this is an addition of risk-free rate of return and premium is nothing but the excess of the market return over the risk-free rate of return. And one way or the other, this is nothing but you might have seen in the CAPM model, and that is what we will be doing in the investment analysis decision making process. The second importance of fundamental analysis is it takes into consideration a long term perspective. So, why a long term perspective and how it is important, we will look into it. So, here we are saying that whatever analysis we are doing in fundamental analysis is going to provide a value for the investors who holds the investment for a long period of time. So, if you look at the stock market, there are two types of players who actually take part in the stock market. One is an investor and the other one is a trader. Okay. So, when I am talking about a trader, he is a person who actually considers speculation and other things which was discussed in the first lecture or first module of this particular course, where what is speculation, what is gambling and other things we have discussed. So, these traders are the persons who actually involve in these activities, and that is why we find that the prices of shares go up or come down. Okay, demand and supply works over here. My major concern is with the investors. So, here investors are those persons who are not actively playing in speculative activity. They are purchasing a share, keeping it for a longer period of time. It's parked with the intention of earning higher returns. So, it's for a longer period of time which we are talking about, and that has nothing to do much with the short term market fluctuations. Third importance of fundamental analysis is to take care of risk management. So, what do you mean by risk management? As you might have seen in the module of risk, what do you mean by risk? Risk is something where I am saying that I am taking you in a flight. We are flying at 35,000 feet above the ground, and there are two persons in the flight. One of them I am asking to jump without any parachute, and the second one I am asking to jump along with a parachute. Now, what will happen in the first case? First case, he does not have a parachute. If you do not have water beneath, if you have just ground, then it is certain that the first person will not be alive. What will happen to the second person who has jumped from the flight with a parachute? It can happen that the parachute opens and he lands down safely. The second condition is the parachute doesn't open, so automatically he will die. So, in the first case, when there is certainty of something to happen and you know it beforehand, then there is no risk involved in it, because you are taking the chance that you are going to die by jumping without any aid. The second case, it may work, it may not work. In that case only there is a risk involved in it. So, you know that putting your money in stock market, you do not know whether it will go up or come down. In that condition, it means to say that there is risk involved in it. And how do you manage the risk? It is by putting your money in investing your money in various companies, and in that manner you are talking about leveraging your portfolio. When I am talking about leveraging the portfolio, some amount could be invested in equity shares, some amount could be invested in debt instruments. Like that you can leverage the whole thing. You are talking about profitability, how much excess you would be earning over and above the risk-free rate of return, and it also is determined by the industry trends. So, whenever you do an analysis and you find that there are certain industries which is not performing well, in which you have already put your money in, then you can switch over by selling those shares and putting it in other shares which will give you a higher return. So, that is something where you call it as squaring of position, right. So, this is likely to happen. Now, there are two basic types of analysis which we can do. One is a fundamental analysis and the other one is technical analysis. Fundamental analysis, as we have seen earlier in the earlier slides, we are talking about studying the company based on the fundamentals in which it is functioning, which includes economic analysis, which includes industry analysis, and which includes company analysis. Okay. So, the actual performance of the company based on its functioning is what we are trying to study in fundamental analysis, whereas in technical analysis, this is based on the historical prices of the shares, and these historical prices are put in the form of charts, and you are trying to study these things. So, basically when we are talking about fundamental and technical analysis, this is the difference. So, one is a ground reality which we have, the other one is the market prices of shares being plotted in a graph, and then you are trying to find out how it has behaved over a period of time. So, this involves both prices as well as volume in certain cases. So, as the analysis is intended to be done. One important criteria as per books, if you look at the difference between fundamental and technical analysis, is that it says fundamental analysis is a long term perspective, whereas technical analysis is a short term perspective, which I do not agree to. Why I do not agree is because the fundamental analysis is done based on the financials of the company, and financials of the company is available to you at the end of every year through the AGM resolutions. Okay. Now, whatever analysis I am going to do in the financials, it would be on yearly basis, and what I can do is do a comparison of year 1 with year 2 with year 3, etc., etc. So, there is a limitation for me in terms of doing the comparative analysis when I am taking the financial statements. So, I consider this to be more of a short term nature rather than a long term nature, which is normally told. But when I am talking about technical analysis, I can have the graphical representation of the prices for 50 years or 100 years. So, what happens is I just plot a graph from say 1900 to 2000. So, I can have a long term perspective, and within this long term perspective, this could be yearly basis, it could be monthly basis, daily basis, timely basis, whatever I want I can divide it, and I can see how the stock has behaved from the first year to the second year, then this to the third year. Like that I can go up to 100 years or 50 years, whichever is required. So, that is the reason why I am considering this to be opposite in nature. Okay? But I am not disagreeing it to the point who are experts in the field who say fundamental analysis is considered as long term and technical as short term. This is my perspective which I have told. And when we are talking about the focus area, fundamentals talk about the value of the company, whereas technical talks about the price movement. So, price movement also the market price movement. Okay. So, this is nothing but when you are plotting the graph, this is the closing price which you have taken. Okay. And if suppose I want to do an analysis on a daily basis at 9 a.m. from 9 a.m. to 3 p.m., then I can do a technical analysis on a daily basis also, which can help me to find out which is the best time for me to enter the market. Let us assume that this is the best time for me to enter the market, that is 11 a.m. and this is the best time for me to exit the market, which could be 2:30 or 2:50 p.m. right. So, like that I can divide my whole thing. So, both are equally important. It all depends on what outcome you require and what type of analysis you are doing, whether you are doing it for a short term or whether you are doing it for a long term perspective. So, depending on that you can do the whole show. So, from this particular introductory, I have just given you an overview of what fundamental analysis is and how it differs from technical analysis, what are the different approaches to fundamental analysis, and how we can go ahead in future to do an economic, company and industry analysis. Thank you.